The initial consensus on the Iran conflict priced in a standard, uniform energy shock across global markets. That framework is now obsolete. What has emerged instead is a structural bifurcation. The market is splitting into two distinct camps: strategic actors exploiting the chaos, and energy-importing sovereigns absorbing the damage. Nations like China and Pakistan find themselves holding leverage the great powers desperately need. China is using the distraction to recalibrate its Taiwan strategy, while Pakistan secures diplomatic prestige as an intermediary. They are extracting geopolitical rent from the systemic friction. On the other side of this divide, energy-importing nations are quietly drowning. They are accumulating compounding fiscal and external account damage that pre-war baselines failed to model. Current asset pricing reflects a dangerous asymmetry. Investors are rewarding these short-term diplomatic maneuvers while ignoring the structural fiscal decay spreading through the rest of the system. The error here is conflating a nation's relevance in global diplomacy with its actual sovereign creditworthiness. These two variables operate on entirely different timelines. A geopolitical narrative premium has a half-life measured in weeks. Debt maturity walls are mathematically immovable. Take Pakistan. The current headlines paint Islamabad as the indispensable, trusted back channel between Washington and Tehran. Behind that prestigious diplomatic facade, the internal arithmetic of the country's IMF standby arrangement is rapidly deteriorating. This chart maps the IMF primary surplus projection against reality. Border clashes with Afghanistan have introduced unbudgeted military expenditures climbing rapidly. Add the hidden infrastructure costs required to sustain a two-front diplomatic posture. This area represents a growing operational void. To cover these gaps, the state bank relies heavily on its net foreign asset position, which is dangerously dependent on remittance inflows from Gulf labor markets. Here's the structural trap. As the Iran war slows economies in the UAE and Saudi Arabia, those exact remittance inflows will forcefully contract. The external buffers will fail precisely when Pakistan needs them most. The fiscally austere government modeled in the IMF's debt sustainability analysis no longer exists. The bond market is trading a ghost. To see the true policy signal, we have to look past the geopolitical front lines and examine the core macroeconomic plumbing of developed markets. The most critical yet underappreciated central bank move of the week happened in Tokyo, where the Bank of Japan decided to hold rates steady. Governor Kazuo Ueda provided an explicit warning. Rising oil prices are now poised to drag down the economy rather than simply force rate hikes. For every energy importing nation, this is a distinct signal. The shock has mutated from an acute inflationary spike into a chronic force of economic contraction. This realization forces a complete reevaluation of the growth models underpinning vulnerable frontier markets. If the institution with the deepest structural experience in managing stagnation views this energy shock as contractionary, the IMF's aggressive growth baselines for frontier markets are inherently broken. We are now tracking a casualty ledger of sovereigns that have moved from managing the external shock to dangerously absorbing it. In Egypt, the government announced emergency fuel conservation measures after natural gas import costs exploded by 300% since the outbreak of hostilities. This diagram outlines the core macroeconomic framework trapping Egyptian policymakers. They are caught between three rigid options. They cannot continue to subsidize energy at previous rates without facing immediate insolvency. They cannot devalue the currency further without triggering a severe domestic cost of living crisis. And they cannot cut essential imports without directly paralyzing national economic growth. Egyptian policymakers are trapped in the center of this triangle. Across the continent in Senegal, we see the alternative to physical austerity, hiding the debt entirely from official oversight. Senegal recently disclosed 650 million euros in hidden, derivatives-based borrowing, a move defended as a mechanism for accessing cheaper financing outside official IMF debt ceilings. Senegal acts as a systemic canary. This discovery raises the probability that IMF debt assessments are understating the actual scale of sovereign burdens across Francophone African markets. Moving to Asian frontier markets, we can observe the final stage of macroeconomic defense exhaustion. The Philippine central bank governor articulated their policy trap with unusual candor, saying they're caught between a rock and a hard place regarding interest rates. Preemptive rate hikes designed to fight imported inflation will actively destroy their remaining fragile domestic growth. This week, the Asian Development Bank activated an emergency support package specifically for countries suffering from the Iran war fallout. This type of multilateral crisis financing signals that member sovereigns have depleted their own primary buffers. They are moving from independent management to external dependency. The activation of this second-line support means the professional bond market is operating in territory where safety nets are already stretching to their absolute limits. To translate this complex macroeconomic diagnosis into a tactical sovereign market execution strategy, it requires building a strict divergence register. We are constructive on South Korea's 2-year duration. The sovereign possesses the institutional insulation and technocratic policy competence to weather the shock. This matrix shows our preference for Philippine short-dated US dollar paper. Holding local duration risk is extremely dangerous. We remain cautious on Pakistan's local currency. Unbudgeted military arithmetic guarantees IMF projections will fail. We are underweight on Egyptian debt until hidden derivatives are priced in. Alpha in this environment is generated exclusively by front-running the inevitable recalibration of IMF models to ground-level reality. The ultimate historical lesson of the intermediary is simple. Thrones borrowed from rival powers require constant recollateralization. The collateral demanded by global instability is always a nation's fiscal sovereignty. Right now, the market is pricing a diplomatic fantasy, but the IMF and the underlying macroeconomic plumbing are pricing cold, unforgiving math. When the narrative and the math finally reconcile, and they always do, the clearing price will be set by the brutal reality of the debt maturity wall. Position for the reconnection, not the fantasy.